Hello, everybody. Welcome to JAIIB English Medium. I hope that all of you are doing fine. Today, we will be talking about the principles and practices of banking in this target series for JAIIB November 2025. As you know that we have been running this series for a while now, and till today, we will we have already covered unit number 35th. So today, we will be covering unit number 36. So till unit 35 you must have seen some of the most important units like the unit on NPA. Then we had one particular unit which is very, very important, the unit on types of securities. Plus, for that matter, one more unit from which the questions are asked time and again. It is your types of guarantees and specifically the deferred payment guarantees, the DPGs. Today we will be talking about the priority sector advances. Fine. So priority sector advances, or for that matter, priority sector lending, that is the unit's name. And the topics which are important, they are beyond imagination. Why I'm saying this beyond imagination? Because in every subject, wherever this particular unit is there, question is always asked. Fine. Be it in IFS, be it in PPB, or for that matter in CAIIB also, wherever a particular topic is there for the PSL targets, or for that matter the RBI's master guideline, questions will be for sure asked. Why it is so? Because it is a target of the public sector banks. The RBI enlists certain targets for the public sector banks, and this is one of the most important target which they will meet. Okay, so now let's start our discussion with the definition of priority sector. When I talk about the priority sector, as the name suggests, something is given priority. Right? What kind of priority is being given here? So the priority sector, basically, it is a concept which has been evolved over a period of time. Fine. In the 1960s, the concept started off with a discussion between the RBI and the government of India, and the government was very, very apprehensive of the conditions which were prevailing in the rural India, the conditions of credit. Fine. So non-institutional credit was at large available in the rural areas, in the semi-urban areas, and the sectors which were unable to gain the growth thanks to this huge amount of rate of interest charged by the private money lenders, they had the potential which was seen by the government. Fine. The government felt that yes, the section of society, or for that matter, these type of industries, especially the small scale industries, we have a potential which can overcome the import export deficit which is there in our country. Along with that, it also felt that there are certain weaker sections in the society which, if we provide loan to them, if we provide credit to them, they can act as a facilitator at some time, at some point of time. They will also act as a catalyst in our economic growth. That is the reason why RBI stakeholders and the government of India sat together and they figured out a particular mechanism via which they will be disbursing loan advances at nominal rate to these particular sectors, and all those beneficiaries will be acting as the prime importance, as the prime target of the public sector banks in this priority sector lending. Okay, so the priority sector lending comprises only those sectors that have substantial influence on the vast portion of the population, especially the weaker section and the sectors that are employment intensive. Fine, where the level of employment is high. Okay. The current framework of PSL dates back to 1967, when the Banking Laws Amendment Bill 1967 was introduced, and it had one particular aspect, that is social control over the banks in India. So it introduced the social control over the banks in our country. What is this social control? If anybody can tell me in the comment section, fine. This will be your homework. If you can, just let me know that what is this social control over the banks. Fine. We have time and again discussed the concept of business entities, and many a times I have referred banks as the business entities only. What is this social control over banks? Do let me know in the comment section. This is just a hint for all of you. So RBI mandated the following benchmarks to determine the PSL targets. Now PSL priority sector lending norms are okay, but how you will be providing with the PSL targets? What will be the benchmark to decide that this particular percentage of your credit or your net bank credit should go towards agriculture? This percentage should go towards MSME. A particular percentage must be lent to the education sector. So there were two benchmarks decided by the RBI. Earlier, it was only based on the total outstanding of a particular bank's balance sheet. But now we have CEOBE as well as ANBC, whichever is higher of these two, you will be lending based on that particular benchmark. What is CEOBE? It is credit equivalent of off balance sheet exposure. It is not a credit. Mind this, very, very important, because normally the benchmarks include the fund based facilities, but here non fund based facilities will be considered as a benchmark, where the exposure of the bank or the risk involved in the banking industry is not directly linked to the credit or the advances. No, they are in proportion to the non fund based facilities only, like the letter of credit, like the bank guarantees. Fine. Directly credit is not disbursed in bank guarantee, or for that matter in the letter of credit. What is going on? Certain amount of assurance is provided by the bank to the borrower, to the multi parties who are involved in that setup. So all those non-fund based facilities, they hold a certain value in the market. Fine. So what is the credit equivalent of that particular exposure? It is defined as the CEOBE, off balance sheet exposure. Why? Because these are not recorded directly in the balance sheet of the bank. They are just taken as a note after the balance sheet. Fine. Supposingly this is the balance sheet here of the bank, and somewhere down here you will find asterisk marked as note, and in the note you will be recording all the exposure that is not fund based. Next, we have the benchmark as ANBC. It is adjusted net bank credit. This you can directly see in the banking industry. You can observe for sure because these are in numbers. You can see the bank credit. What is the number of bank credit? What about the bills rediscounted with the RBI? What is the number there? Fine. So bank credit subtracted from the bills rediscounted with RBI will somewhat give you the bank's net credit. But what is this adjusted net bank credit? It has some more, you can say, components to it. After you arrive at the bank's net credit, you will have to add the non-SLR category bonds or investment and subtract the loans from the RBI. Right? So ANBC, let's have an elaborate discussion on this, because question can be asked in the examination that calculate the ANBC of a particular bank based on the data provided. So this adjusted net bank credit, mostly you will find in the books also, it is not defined as a particular formula, but here we will be deciphering it using a formula only. So RBI introduced the Bills Market Scheme, which is known as BMS, in 1952, which was later registered as the New Bills Market Scheme, NBMS. Now, what is the basis of this NBMS? Here, RBI will be providing discount to the banks on already discounted bills. Bill discounting we have seen, fine. So already a particular bill has been discounted by the bank for the particular customer of this bank, but the particular bank which has discounted the bill, it will approach the RBI under the NBMS and it will rediscount this bill. Fine. So all the bills which are rediscounted, they form a part of ANBC, one part of ANBC. This bank credit, when I say bank credit, it involves the overall credit which is floating in the market of a particular bank. Supposingly 100 crore is the credit or the advance amount which the bank has floated in the market via various loans, and out of it, right now, currently, when we are calculating the ANBC, it is able to recover 70 crore. Remaining 30 crore right now, whether it is to be recovered or it is ongoing loan only. So that particular amount, 30 crore, we won't be adjusting here. We will consider the bank credit as 70 crore. So second part will be bank credit. First one, bills is rediscounted. Then we have bank credit plus one more component will be there, which is known as non-SLR bonds. See, there are certain bonds known as the SLR bonds, where there is a statutory limit defined by the RBI that yes, a bank must have this amount of assets sidelined for the time when the economy will be in a slump. We will be using these type of assets, these reserves at the time of a slump in the economy. They will act as a reservoir for a bad time for the economy. So apart from these SLR reserves, whatever bonds are there, they will also be included in the calculation of ANBC. So third component will be non-SLR. Fourth one will be your investments under the priority sector lending. So in total, there are 8 plus 1 sectors in the priority sector. Fine. And these 8 sectors clubbed with 1, they form the total 9 priority sectors. Whatever investment a bank has already made in these PSL under the PSL norms will be the fourth component of your ANBC. Lastly, the fifth component, which normally bankers know already, it is the outstanding deposits under the RIDF. So, Rural Infrastructure Development Fund. What is the role of RIDF here in the ANBC? All those obligations which are supposed to be fulfilled by the banks but were not fulfilled for one reason or the other under the priority sector lending, they will be redirected by the RBI in the fund known as RIDF, so that it will be again taken care of or again accounted for while calculating the ANBC. So these 5 components you must remember: 1, 2, 3, 4 and 5. So from the bank credit, you have to subtract the bills rediscounted. Fine. Otherwise, what will happen? In this bank credit, already discounted bills will be added. So duplicacy will be there. So you have to subtract it. Then add the non-SLR bonds and the investments under PSL and the outstanding deposit under the RIDF, and you will arrive at ANBC. This is written here also, that bank credit, which is the amount which has been recovered from the customers till date. That is this 70 crore, the example which I was giving you, minus the bills rediscounted with the RBI will give you what? Net bank credit. So in total, when I talk about the entire circle, you will find what? These two, 1 and 2, that is bank credit and your bills rediscounted, they will form a part of these two club together, they will form a part of net bank credit. This part is known as your net bank credit, that is NBC. Fine. Now add non-SLR category bonds and other investments that come under PSL and the outstanding deposits under the RIDF, where the unused obligation under the PSL will be deposited by the bank and outstanding amount under the PSL targets minus the loans from the RBI. Fine. So the loans from the RBI will be subtracted at arriving for this particular number. Okay, so this is how you will be calculating the ANBC if a question is there at all. And when I talk about the computation of ANBC, in the case of the definition provided by the RBI, it has various components. So the bank credit in India is one component. Then we have bills rediscounted with the RBI. Then net bank credit. Fine, these two we have seen already. Outstanding deposits under RIDF. Again, we have seen this. Then eligible amount for exemption on issuance of long-term bonds for infrastructure and affordable housing. This we must remember because direct question can be asked where the amount for the exemption is already given. So if you know that the issuance of long-term bond for infrastructure and affordable housing will provide certain exemptions to you, that will be added here. Advances extended in India against the incremental FCNR NRE deposits qualifying for exemption from CRR or SLR requirements. Then when I talk about this particular eighth and ninth, yes, this is eighth, this is ninth, fine. This one is eighth and this is ninth. Other investments eligible to be treated as priority sector, subtract them from the face value of securities acquired and kept under held to maturity category under the TLTRO 2.0. See, these figures will be given in the exam. You have to only subtract or add various components. So always remember this eighth one, 8 minus 9 will be the criteria for calculating the ANBC for UCBs. Bonds or debentures in non-SLR categories under the HTM category. Again, non-SLR bonds will be there. For UCBs, investment made after August 30th, 2007 is permitted. Non-SLR bonds held under the held to maturity category. So HTM category for this type of structure will also be added up. Fine. So mostly the question revolves around this classification of ANBC. But yes, if you are a newbie, you do not know how the exemptions will be provided or how the exemptions will work, then always remember this particular outstanding deposit under RIDF, that is fourth, you have to subtract it from the exemptions on issuance of long-term bonds, that is 4 minus 5. This is 5, this is 4. Okay, the rest all will be added up. Fine, you can see that this one third, as we have already seen here, it was what, 1 minus 2. The bank credit will be subtracted from the bills rediscounted and you will get the third. Okay, so ANBC other than UCBs you will have 3 plus 4 minus 5. What is 4? 4 is this one, RIDF, outstanding deposits under the RIDF, minus the exemption on the issuance of long-term bonds. Plus you will be adding 6, 7, 8, and finally subtracting this ninth one as well. That is the face value of securities acquired and kept under HTM category. And lastly, you will add the non-SLR bonds as well. Okay, that will give you the ANBC other than UCBs. Fine. So I hope that now you will be able to handle a numerical if there is any in the exam based on the ANBC. When I talk about COBE, direct numerical is not there. The scope of asking numerical from COBE is very limited. And here for all of you, a reference sheet has been attached, which is an old one, very old, 2003, 2004. That's what we can gather for you so that you can have a look that how does this COBE looks like. So here you can see off balance sheet exposure of the scheduled commercial banks. So forward exchange contract, guarantees given, acceptance, endorsements, all these things will be there in the off balance sheet exposure. So in total, they are not a part of asset or liability in bank balance sheet, not classified in loans or for that matter deposits, but they create income for the bank. Income will be created. Like LCs, you will be having as a banker certain income based on the charges. The service fee will be levied to your customer. It represents the potential credit risk, not the direct credit risk, but the potential credit risk. That is the credit equivalent arising from the bank's off-balance sheet activities like unused loan commitments, subtracting the outstanding principal from the loan commitment. So whatever loan commitment was there and it has been fulfilled from the banker's end, but the customer has not fulfilled the same to the importer. Fine, the amount has not been provided by the importer to the exporter, and the goods and services are not provided to the importer by the exporter. Anything can happen. Fine. So CEOB, always remember, it is just a credit equivalent of these off balance sheet exposure, mostly given under the head of letter of credit, or for that matter, bank guarantees. Fine. Now, when we talk about the priority sector lending, we have a good amount of discussion based on the ANBC and CEOBE. Apart from this, you have to remember that what all priority sectors are there. So when I talk about the agricultural laborers, or for that matter, the agriculture sector as whole, it forms one part. Then we have the MSME, then export credit, social infrastructure, housing, education, renewable energy, others, and your weaker section. All these clubbed together will be what? 8 plus 1. Fine. This is education. Then we have renewable energy, and lastly we have others category. uh, by mistake it has been written in the one column only, but nonetheless, fine, these are the three different priority sectors. Okay, this others category mostly includes the corporates. Fine, the corporates to which loans will be disbursed on priority by the scheduled commercial banks, as prioritized by the, as obligated by the RBI under this particular master direction. This is the master direction which was revised by the RBI in March 2025, which gives the total priority sector, agriculture, micro enterprises, and advances to weaker sections target to the various banks. Types of banks involved are domestic commercial banks, excluding RRBs and SFBs. Why they are excluded? Because they have been categorized separately. The regional rural bank and the small finance banks. Then we have the foreign banks with less than 20 branches as a different category. And the domestic commercial banks are clubbed together with the foreign banks with 20 branches and above. Fine. So this is the most important master guideline from which 100% questions will be asked. Fine. I'm not boasting anything that every time question will be asked, but yes, that's how the IIBF pattern has been till May 2025. Either in the IFS subject or for that matter in PPB, at least one question is from this particular table. So if you want to have a complete discussion around this particular priority sector advances section, then you can join our Mahapack for the same. Fine. This JAB increment Mahapack will not only provide you with the elaborate discussion on all these units, all these concepts, but also it will serve as the one-stop solution for your entire JAB preparation. It will provide you with the JAB Mahapack 2.0 as well as JAB increment box. This increment box will give you the physical materials. Fine, physical materials, I mean to say that 4 printed books will be delivered to your home, to your address, whatever you are providing in the uh, while taking the admission. So 4 books will be there, plus formula sheet along with that study planner, ADA 247 merchandise, and affirmation cards will be included in this JAB increment box. And when I talk about the Mahapack, here you will have the online live classes, recordings will be given of these classes also, ebooks will be there, and unit wise mock as well as full length mocks will also be there. So without wasting any time, make an informed decision to purchase the JAB Increment Mahapack, because indeed after purchasing the JAB Increment Mahapack, only thing which you need is consistency to cover the syllabus with us on your own. Fine, that is the thing which you have to show, that is consistent efforts. Rest we will take care. Whatever the directions are there in the lectures, you must follow that. If a particular mentor is saying that practice is important and revision you must do in a stipulated timeline, follow that, and your chances of qualifying this particular JAB in November 2025 will multi-fold. Nobody can assure you that yes, 100% guarantee is there that buy our material, study material, and you will sail through this exam. No, but the chances will become higher. Yes, that is what we can say. Okay, so if you have any kind of doubt, do let me know in the comment section. And if you are new to our channel, do subscribe the channel, share with your friends and colleagues who want to learn new in the banking sector. Fine. So we'll meet